Hi, I'm Rob Lockhart from the Davidson Institute, here to talk to you about the ins and outs of borrowing. Borrowing is an integral part of our financial journey. However, if not managed well, it can have a detrimental effect on our financial position instead of enhancing it. This video addresses the basics of borrowing to help you get on the right footing when using credit. Now, before we get into it, I need to let you know that this information does not take your personal objectives, circumstances, or needs into account. Consider its appropriateness to these factors before acting on it. Read the disclosure documents for your selected product or service, including the terms and conditions or product disclosure statement before deciding. If you wish, you can speak to your financial advisor or accountant or one of our bankers for detailed information relevant to your personal circumstances. During this video, we are going to lay the foundations for using credit efficiently to achieve our goals. The three key areas that we are going to focus on are: why borrow? Looking at the reasons people borrow money. Types of credit. Different types of debt have different purposes and should be matched to the purpose of the borrowing. And be aware, if you are going to borrow, what are some of the things you should take into consideration when making that decision? Firstly, I want to look at why borrow. Because a common reason for people getting into financial difficulty is because they have borrowed for the wrong reason or they have the wrong type of borrowing for their original purpose. There are three main reasons we borrow money. The first and most common reason for borrowing is to buy things now rather than later. Whether it's a house, a car, furniture, computers, or simply that new pair of shoes, or maybe the latest electronic gadget. We want these things, and we are not always prepared to save up to buy them because the time taken to save means we potentially miss an opportunity. The second reason people borrow is to invest, or if you like, boost our wealth generation potential. We may wish to buy an investment property, share portfolio, increase our super contributions, or invest in a business. Effectively, investing is a way to increase our wealth so we can buy more stuff in the future by selling that investment or using the income from those investments. The final reason people borrow is to alleviate a mismatch in cash flow timings. For instance, perhaps your pay is due to be deposited in the bank account on Thursday, but a bill needs to be paid a few days beforehand, such as your rent or rates or school fees or insurance or whatever it might be. Now, you will have the cash in a few days' time, but you need it today. This is where credit cards and short-term debt may be useful. You can pay for the regular stuff now, knowing that you can repay the debt when you receive your pay in a few days' time. The best way to understand credit or borrowing is to explore the fundamental difference between saving and borrowing, and why both potentially play an important role in any financial management strategy. At the heart of this discussion lies the fact that we want things. Things like cars, like houses, like education, holidays, clothes, and so on. And to get those things, we need to pay for them. There are two different ways that we can do that. Firstly, we can crack open the piggy bank and use our own savings to pay for what we want. This is a good approach because once we have paid for the thing that we want, we own it outright and can do what we like with it. But of course, it can take a lot of time to save up enough money to actually get what we want. But what if we want that thing right now? Or maybe even more importantly, what if we need to have it now? Well, that's when you might choose to borrow. Borrowing will cost more in the long run and take a bit longer to pay off. But, and here's the important point, we can have the thing right now. So, in practical terms, both saving and borrowing are two different ways of achieving the same goal, getting the thing that you want. The key to determining whether to use your savings or get a loan lies in understanding the requirement around when you need to access the thing that you are purchasing and how using a loan will change the total cost of the purchase. Ultimately, it's about getting the right balance between saving and borrowing, then borrowing well to ensure the credit supports your overall goals. Let's have a look at the example of buying a car. If you were to save up to purchase a car that costs, say, $25,000 and you could save $470 per month, it would take you a little over 4 years to save up that $25,000. But of course, in 4 years' time, is your $25,000 going to purchase the same type of car that it will today? Prices may have increased, and so your $25,000 may potentially only buy an inferior car. But the good news is, it may have only cost you roughly $23,800 of your own money, with the other $1,200 being the interest that accrues on your savings over that time. Now, on the other hand, if you were to borrow to purchase the car now on an unsecured loan, it would take you 7 years to pay off the loan at the same rate as you are saving, that is $470 a month. Including interest and fees, this is actually going to cost you about $39,580 of your own money. And of course, once you've paid that nearly $40,000, you will have a 7-year-old car and potentially have to pay a higher price again just to replace it. Oh, don't forget, whether you save or borrow, during the time of ownership, you will also have to pay for the running of the car, fuel, maintenance, and so on, which is another thing that needs to be budgeted for. Now, this may mean you are not able to repay at the same rate as you were saving, and thus it would take you even longer to repay the loan and it would cost even more. Whichever way you look at it, whether you borrow or you save, this scenario uses at least $470 a month from your budget. Make sure you are realistic with your budget when allocating the amount you either want to save or repay. The second reason we borrow is to invest. Typically, most of us think of using our own money when we invest. Having said that, though, a lot of people will borrow to invest. Some examples of borrowing to invest include taking out a mortgage on an investment property or borrowing money on a margin loan to purchase shares. Let me take you through an example to explain why people may want to borrow to invest. Let's say you invest $100 of your own money. This can be referred to as your equity. Now let's keep the math simple and say that you could get a return of 10%, which will make you, of course, a profit of $10. However, if you were to use your $100 equity as a 20% deposit and borrow $400, you would have $500 to invest. If you could still get a 10% return, this calculates out to earnings of $50. Now, of course, you will have to pay interest on the $400 borrowed. And again, for ease of calculating, let's say the interest rate on the loan is 5%, therefore costing $20 and leaving a profit of $30, higher than the original $10 in earnings on just your $100. Borrowing to invest can provide a positive outcome where the returns are higher than the cost to borrow. Borrowing to invest can be an effective way to help build wealth. And borrowing for the investment gives you a larger amount of money to invest up front, enabling you to benefit from returns on a larger amount. Of course, this may open up other investment opportunities, such as an investment property or maybe a larger tranche of shares. Now, borrowing to invest is also known as leverage or gearing. You are said to be positively geared when the cash or income returns on your investments cover all the costs of borrowing to invest. You are said to be negatively geared where the cash or income returns on your investments fail to cover all the costs of borrowing to invest. Now, there may be possible tax benefits when you borrow to invest, which include being able to claim interest and fees as well as franking credits. But you should seek appropriate financial advice before using this strategy. Whilst gearing can magnify gains, it can also magnify your losses if your investment returns are negative. Borrowers, of course, are liable for the interest cost and repayment of the loan, regardless of whether their investment makes or loses money. Loans may need to be repaid from selling other assets, which may even be the family home. So, given greater risk is involved, you should be comfortable that gearing is consistent with your risk profile. Borrowers should ensure they have sufficient income to service the loan and any interest rate rises from other sources than the investment. The third reason people borrow is to cover mistimings in cash flow. That is, when you have an expense, generally unplanned for, that needs to be paid before you have the cash available to pay for it. Many people will ration their money from payday to payday to ensure they have enough for known expenses. But what if the car breaks down? Or you need to have some emergency plumbing done? If you don't have enough cash available, then you may choose to borrow to cover that shortfall. For example, my friend Mary gets paid on a fortnightly basis, so she has her rent set up to come out of her account the day after payday. She does her grocery shopping and any general errands the weekend after she gets paid, as well as allocating money for her phone, electricity bill and car registration. So the balance of her account tends to fluctuate like the graph on the screen. But then last week her car needed some emergency repairs. While she knew she would have the money once she got paid again, right now she needed to pay for the repairs and she didn't have enough cash available. So she needed to borrow to cover the shortfall. But then of course repaid it as soon as she got paid. Now this is where people can sometimes run into trouble. If these little mistimings are not repaid, but continue to accumulate, say on a credit card, it's possible to end up with an unnecessary debt that can become costly and even detrimental to your financial profile. Debt created by cash flow mistiming should be repaid as soon as possible. And if they're becoming a regular occurrence, then it might be time to look at how you are spending your money and whether your budget needs to be adjusted. Now that we know why we borrow, let's take a quick look at the different types of borrowing or the different types of credit available. Now, before I talk about the different types of borrowing, a cardinal rule you should always remember is to match the life of the loan to the life of the asset. Let me give you an example. Some years ago, my mate Joel wanted a new car, but didn't have enough cash to buy it. But he did have a redraw facility on his home loan, which he drew down to pay for the car. Now, Joel thought this was great, as the home loan had a lower interest rate than he would have paid on a personal loan, and he didn't have to increase his repayments. On the downside, though, the car died recently after a good 8 years of life. However, he still has another 10 years left on the home loan. Because he didn't increase the repayments on the home loan, he'll continue to pay this car off and be charged interest for the remainder of his home loan. And because he had no room left on the home loan or savings to buy another car, he's had to borrow for a new car and is now effectively paying off 2 cars. Always think about what you are buying and how long it will last, and aim to pay it off before it reaches the end of its useful life. The first type of credit card we'll look at is short-term loans, such as payday lenders, overdrafts, credit cards and buy now, pay later schemes. These types of loans should be used for timing differences. I need to pay for something now that I could afford to pay from my regular income, but I will not get paid for a few days or weeks. A payday lender will advance you money against your next pay. The interest rate is often high and the penalties for not repaying are also high. You may be able to get an overdraft through the bank. This may be arranged or unarranged. Unarranged means a payment comes out of your bank account which does not have enough cash in it, but the bank allows it to go through, putting your balance into debit. You will be charged a fee and interest until you put the money back into the account. An arranged overdraft, on the other hand, is an overdraft you apply for and a limit is put in place. You will generally be charged a lower interest rate than an unarranged overdraft, and it would be unlikely that an overdrawn penalty fee would be applied as long as you stay within your approved limit. Credit cards are generally issued by the banks, credit unions or finance companies. There are a number of different types, some with interest-free periods and a higher interest rate, or no interest-free period but a lower interest rate. Some will offer different reward programs, but these are generally the most expensive in terms of fees and rates. If you have a card with an interest-free period and will pay the balance off within that period, then you should only need to pay the card fee. If you do not think you'll pay it off in the interest-free period, you would most likely be better off with a card that has a lower interest rate. A recent addition to short-term borrowing are things like Afterpay and ZipPay and the likes, which offer interest-free buy now, pay later services. These services are often offered by the retailer who gets paid directly by the lender, and then the borrower, that's you, repays the lender via a series of direct debits to your account, which is set up when you register with the lender. While this might seem like a great deal, if you are going to use these services, please make sure you understand the terms and conditions and ensure you have the money available in your account when repayments are due. You don't want your purchase to end up costing you more in the long run due to late payment fees by the lender and dishonour fees from your bank. When buying larger items that will take more than one pay period to pay back, you may still use your credit card, but it may be more appropriate to use some type of personal finance or vehicle finance if you are purchasing a car. Some different types of personal finances are a personal loan, which is a mid-term finance, often 2 to 5 years, with regular repayments. You will usually pay interest and fees, and once the loan is paid off, the thing you purchased is yours. Another type of personal finance is rent to buy. With this type of finance, you are paying a rental for the item with the intent of buying the product at the end of the agreed term. This is often used for furniture or household appliance purchases. Take care to add up the total rental and the amount to pay at the end to see how much it will actually cost you. A consumer lease is like rent to buy, but you may not have the option to buy it at the end. With interest-free periods or buy now, pay later, you should look closely at the terms and conditions. Quite often you get charged ongoing fees instead of interest, and there can be severe penalty rates if you miss a payment. Similar to a rent to buy, you should check if the repayments add up to the total cost, as you may have a large payment to make at the end. Car loans or vehicle finance are like personal loans and may be secured by the vehicle or unsecured. Generally, unsecured will mean you have a higher interest rate and maybe a shorter term, which will increase your repayments. Home loans are just longer-term personal loans secured by a mortgage over your home. They may be up to 30 years, as you would expect your home to last for this period. Remember though, if you pay off a little more than your repayments, you will generally pay it off more quickly and not pay as much interest. An investment loan is used to purchase income-producing assets or assets that will get capital growth. The interest rate will be higher than a home loan, and the term of the loan may be shorter than a home loan, but generally longer than a personal loan. Now, as we looked at earlier, if you are borrowing to invest, check whether the investment is likely to return you more than the cost of the borrowing, and be careful of investing in assets whose value fluctuates a lot. These are the main types of borrowing. Now let's look at some of the things to be wary of if you do make the decision to borrow. First of all, borrowing does not come free. There are various costs, including interest and fees, that will need to be paid, and you will have to pay the money back. The costs can generally be broken up into your setup or establishment fees, which the financier will charge to set up the loan. The amount will vary depending on the complexity of the transaction. Interest is the premium you pay to use someone else's money. There may be ongoing fees or charges. Many financiers will apply a monthly account keeping fee or something similar. There may be exit fees, because a financier borrows the money for your loan and may have to break that borrowing when you repay early. So there may, and quite often is, an early exit fee. And of course, don't forget your penalty fees, which are applied if you do not pay on time or you breach the conditions of the borrowing. The amount and type of fees charged will depend on the type of borrowing, the terms and conditions of that borrowing, and the security provided for the borrowing. When comparing different types of borrowing or different financiers' offerings, make sure you have taken into account all interest, fees and charges, as some lenders may make it sound better by offering you, say, a cheaper interest rate, but their fees and charges may be higher. Once you enter into a borrowing arrangement with a bank or financier, it is incredibly important to ensure you meet the repayment arrangements. Make sure you know when your payments are due and that you have the money available. But let's face it, sometimes we do run short and may not be able to make a repayment. Instead of just hoping for the best, the bank won't notice, be proactive and let them know you are going to be late. By making other arrangements, they know you are committed to making the payment, but you just can't make it right now. The more you communicate with your lender, the less likely they are to take action that could be detrimental to your credit history. The key pitfall or cause of bad borrowing is when our repayments and interest can't be met from our budget. Some people have a tendency to pay for this shortfall, say, with their credit cards. But let me tell you, this is a slippery slope that can lead to your financial ruin. If you find yourself in this situation, go back to your budget and work out what expenses you do not need and cut back. Remember, all borrowing should be repaid from your regular income or the sale of assets. If you understand why you borrow and know it fits within your income, then you will generally be engaging in good borrowing. Be wary of just paying the minimum repayments on your credit cards. Let's say you had a $10,000 outstanding on your credit card and you paid the minimum 2% with a 20% interest rate. It will take you 77 years to pay it off and cost you $43,000 in interest. By paying as much as you can reduce the interest cost and exhibit as a good borrower. When it comes to borrowing, your credit history is incredibly important, as this forms a large part of the credit provider's decision to lend you the money or not. Now, it's simply a record that is kept by credit reporting agencies such as Equifax, Experian, and Ilion of all your past credit inquiries and applications, details of any existing borrowing, your repayment history, and if there are any court judgments or bankruptcies filed against you. These records are accessed by a credit provider whenever you apply for a loan or take out a mobile phone plan. It tells the credit provider about your past conduct and helps them decide whether you are a good risk and are likely to repay a loan. You are also able to access the information kept about you, and it's advisable that you do so on a regular basis, say once a year, to ensure it remains accurate. Visit creditsmart.org.au for more information on your credit history. Borrowing money to buy things, invest, or just to cover timing differences can enhance your life, but make sure you are getting the right type of loan for what you are borrowing for. Remember that cardinal rule: match the life of the loan with the life of the asset. Understand the full cost of any finance and ensure you have budgeted for the repayments. Finally, make sure you pay all your commitments to keep a clean credit record. Thank you for watching our video on borrowing.